It is definitely that time of year again, the season of giving. And as the year starts to wrap up, you're probably thinking about the causes you really care about. But what if I told you that you could make your generosity work even harder? Today, we're going to unpack three really powerful strategies to make your year-end giving both more impactful and, incredibly tax smart. So, are you feeling that year-end pressure? It's a real thing. Did you know a full third of all charitable giving happens in December, right in the middle of all the holiday craziness? And in that rush, it's so easy to just focus on where you want to give. But figuring out how to do it smartly, that can feel a little overwhelming. You want your gift to make a huge difference, of course, but you also want to be savvy about it, right? So, where do you even turn for help? Well, this is exactly where your local community foundation comes in. You should think of them as your personal philanthropy guide. They're an expert partner who just simplifies the whole process, making your generosity way easier and so much more powerful. Let's dive into the first strategy they can help you with. First up, we've got a strategy called bunching, and this is such a clever way to reclaim the tax benefits of your generosity. With today's standard deductions being so high, a lot of people are finding that their annual giving doesn't even qualify for a write-off anymore. Well, bunching, that's the solution to that exact problem. So how does it actually work? It's pretty simple, really. Instead of giving, say, the same amount every single year, you bunch several years of those donations into one single larger contribution. This one big gift is often enough to push you right over that standard deduction line, which lets you itemize and get the absolute maximum tax benefit for that year. But wait a minute, you don't want to flood your favorite charity with money one year and then leave them high and dry the next, right? The solution is a donor-advised fund, or a DAF, and it's managed by your community foundation. You make your big, bunched contribution to the DAF, you get that immediate tax break, and then, here's the beautiful part, you can grant that money out steadily to your favorite causes over the next few years. It's the perfect way to get the tax benefit now while still making sure you give consistent support to the organizations you love. So, we know timing your gift is smart, but what about what you actually give? Our second strategy is all about unlocking the hidden power that's sitting right there in your portfolio. While most of us just think of giving cash, there's often a much more tax-efficient asset you can donate. On the left, you see giving cash. It's simple, sure, but look at the right side. This is where the magic happens. Giving appreciated stock. When you donate stock that's grown in value, you get this incredibly powerful double tax benefit. First, you can deduct the stock's full market value. And second, and this is huge, you completely sidestep the capital gains tax you would have had to pay if you sold it. It's a total win-win. The charity gets more and you pay way less in tax. Now, you might be thinking, okay, that sounds complicated, but it's really not. This is another area where your community foundation just shines. You just identify the stock, you contact them, and they handle the entire transfer and sale. Seriously, they make one of the most powerful giving strategies out there incredibly simple to pull off. All right, our third strategy is a true game changer, especially for anyone who's 70 and a half or older. It's all about turning your IRA into a powerful tax-free tool for giving. This right here is the magic number, 70 and a half. Once you hit that age, the IRS allows you to make something called a qualified charitable distribution, or QCD, directly from your IRA to a public charity. And the benefits here are just massive. You can give up to $108,000 a year, and that money is completely excluded from your taxable income. I mean, it's not a deduction, it's actually better than a deduction. It's income you never even have to report. This move can also satisfy your annual required minimum distribution, all while lowering your IRA balance to potentially reduce future taxes for you and your family. Now, there is one very important rule to know. The IRS does not allow you to make a qualified charitable distribution to a donor-advised fund. That's a critical distinction, so you gotta remember that. But there's a really smart alternative. And once again, your community foundation is the key. While you can't send a QCD to a donor-advised fund, you can use it to create other types of powerful, permanent charitable funds directly with them. Just look at these options. You can use your QCD to create a designated fund that provides annual support to your favorite nonprofit forever. Or you could start a field of interest fund to support a cause you're passionate about, like the arts or animal welfare. You could even set up a scholarship fund to help local students. You have incredible flexibility to create a lasting legacy, all while getting those awesome tax benefits of a QCD. So, if there's one key takeaway from all of this, It's that you have a partner in this journey. You absolutely do not have to figure out these complex strategies all by yourself. Your Community Foundation is there to be your expert guide. So here it is, your smart giving checklist. Just remember, bunch your donations using a DAF to maximize your deductions. Give appreciated stock to get that amazing double tax benefit. And if you're over 70 and a half, use a QCD from your IRA for totally tax-free giving. And what's the common thread through all of it? Your Community Foundation makes it happen. So, you ready to get started? Your first step is to have a chat with your financial advisor to see which of these strategies is the best fit for you. Then, connect with your local community foundation. They are ready and waiting to help you build a plan and turn your charitable vision into a reality.